What if I told you there's a simple but proven way to build wealth over time without taking huge risks? In this video, I'll explain what compounding is, how Einstein called it the eighth wonder of the world. We will reveal the magical force that can exponentially grow your wealth. Now, before we get started, I know what some of you might be thinking. How you can implement this knowledge in your own lives. Well, imagine if you could turn a small amount of money into a fortune over time without winning the lottery or inheriting a windfall. That's what the power of compounding can do for you. It's like a snowball rolling down a hill, growing bigger and faster with each roll. So, if you are tired of living hamster wheel lives, struggling to make ends meet, and want to unlock the key to financial freedom, then my friend, you are in the right place. By the end of this video, you're going to walk away with some amazing benefits. First and foremost, you'll gain a solid understanding of what compounding is and how it works. You'll know how to start small and let your money do all the heavy lifting. Secondly, I'll guide you through various assets that you can invest in which harness the true power of compounding. So grab a sit, hit that subscribe button, and let's dive into the details. All right, let's start at the beginning. What exactly is compounding? I know it sounds boring, but stick with me and let me explain this to you. Simply put, it's interest earning interest. It's the magic of earning interest not just on your initial investment, but on the interest it accumulates over time. The earlier you get started, the more time your money has to grow. Compounding is a game changer, my friends. Albert Einstein himself actually called compound interest the eighth wonder of the world. He said, quote, "He who understands it, earns it. He who doesn't, pays it." Let me break this down. He who understands it, earns it, means if you understand how compounding works, which is like making money from the money you already made, you can use it to make more money. He who doesn't, pays it, means if you don't understand compounding, you might end up losing money. For example, if you borrow money and the interest compounds, you could end up owing more and more money over time. So it means that understanding compounding can help you grow your money, but not understanding it can cost you money. It's like a tool. Use it right, and it helps you. Use it wrong, and it can hurt you. Let me give you another example. Warren Buffett, one of the richest person in the world. He bought his first stock when he was just 11, and now he's worth over $120 billion, thanks to the power of compound interest, which is like a snowball growing bigger as it rolls down a hill. This is why his biography is called The Snowball. He really understands how to make money grow over time, and it's a good idea for you to learn about it too. While Buffett started young and has maintained his investment snowball for decades, you don't need to be the next Buffett to benefit from compounding. Sure, matching his off-the-charts returns and astronomical wealth would be extremely difficult. But with patience and discipline, all investors can harness the magic of compounding to achieve financial freedom. The key is understanding how quickly consistent investment gains compound when continually reinvested over long time horizons. This exponential growth effect that Buffett leveraged so successfully can work for you too. It's important not to fall into the misconception that unless you possess the intellect of Albert Einstein or the financial prowess of Warren Buffett, you can't reap similar benefits. While we may not all build billion-dollar fortunes with smart strategies and commitment, compound interest can still help us achieve a very comfortable lifestyle. Let's consider an example to help you understand the compounding effect. Imagine you invest $1,000 in a savings account with a 5% annual interest rate. You earn $50 interest, so after the first year, you have $1,050. But here's where the magic happens. In the second year, you earn 5% on, which is $52.50. So now you have $1,102. As years pass, you earn interest not only on your initial investment, but also on the interest you've accumulated. See how it starts snowballing? Isn't that fascinating? Now, think about how this could work for you. If you start investing early, even small amounts can grow into substantial savings over time. Now let's talk real benefits. Let's say you're 25 years old and you start investing $200 per month in a retirement account with an average annual return of 8%. By the time you're 65, you would have invested $96,000, but your account balance would be over $700,000. That's the power of compounding. And here's the kicker. You don't have to be a finance guru. You simply allowed time and consistency to do the heavy lifting. This is how money can grow from modest amounts to enormous sums over time through the magic of compounding. The longer your money stays invested, the more powerful the impact. This works for savings accounts, stocks, real estate, any appreciating asset. Let me explain how to leverage one of the popular asset class, stocks. Do you know what a stock is? Let me break it down for you. Stocks represent ownership in a company. When you buy a stock, you become a part owner of that company. Stocks have the potential for high returns, and they're a great way to leverage your money. Now, imagine investing in a company like Amazon or Apple. When these companies grow and make profits, their stock prices typically rise. Do you know how can investing in stocks contribute to compounding wealth? Well, my friend, stocks have historically offered higher returns compared to other investment options like bonds or cash. By investing in carefully selected stocks of growing companies, you have the opportunity to benefit from not only the growth of the company, but also the power of compounding. As the company's profits increase, its stock value rises, and your investment snowball grows larger. The key is reinvesting dividends and capital gains. Public companies aim to pay dividends, regular cash payments to shareholders. By reinvesting these payouts into more shares instead of pocketing the cash, you compound your holdings. Plus, reinvesting dividends allows dollar cost averaging. You buy more shares when prices dip, lowering your average cost. This boosts long-term gains. Let's look at Jeff Bezos, the founder of Amazon. He leveraged stocks by investing in his own company. Today, Amazon is one of the most valuable companies in the world, and Bezos is one of the richest people on the planet. Let's consider someone who invests $1,000 in the stock market with an average annual return of 8%, which is achievable over time. After the first year, they would earn $80 in interest, resulting in a new total of $1,080. In the second year, they would earn 8% on $1,080, which equals $84. After the third year, the interest of $84 would grow to $94, and so on. Over time, compounding really amplifies your returns, turning small investments into significant amounts. Compounding interest is like a magic wealth escalator when used strategically with stocks. Time and consistency are key. The sooner you start reinvesting, the sooner your money starts working for you exponentially. Now here's a question for you. What's one stock you're interested in and why? Share your answers in the comments below. We'd love to hear from you. And let's not forget the bond market. How can bonds play a role in leveraging compounding? Are you familiar with how bonds work? Well, bonds offer a different opportunity for compounding. Bonds are essentially loans where you lend money to either a government or a corporation. In return, they promise to pay you back the principal amount, known as the face value, at a specified future date called the maturity date. Additionally, they pay you interest, known as coupon payments, usually on an annual or semi-annual basis. Now, here's where compounding interest kicks in. If you reinvest the coupon payments rather than spending them, the interest on those reinvested payments can compound over time, just like we discussed with stocks. So, how can you leverage bonds and compounding interest to benefit your financial journey? Don't worry, I'll explain this for you. The first step is to consider investing in quality bonds that align with your risk tolerance and investment goals. Look for bonds with reliable issuers and solid credit ratings. Then, instead of spending the coupon payments, reinvest them in additional bonds or other investment vehicles that can compound your returns over time. The longer you can keep reinvesting and compounding, the better your outcomes will be. Remember, it's crucial to keep in mind that bond investing can be complex, so I recommend seeking advice from a financial advisor to ensure you make informed investment decisions. They can guide you through the process and help you select suitable bonds that align with your financial goals. Additionally, consider opening a brokerage account or exploring options to invest in bond mutual funds or exchange-traded funds, ETFs. Educate yourself about different types of bonds and their associated risks. Remember, knowledge is power in the world of investing. Let's consider an example where you invest $10,000 in a bond with a 5% annual coupon rate for 10 years. At the end of the first year, you would receive $500 as a coupon payment. If you reinvest that $500 back into bonds with a similar interest rate, your next coupon payment would be $525. Over time, these reinvested coupon payments can compound and grow significantly, increasing the overall returns from your initial investment. Start by identifying potential bonds and looking for ways to leverage them. And don't forget, it's never too late to start. In the comments section below, share your thoughts on whether long-term government bonds or corporate bonds are more appealing for leveraging the power of compounding interest. Now, we will delve into the realm of real estate and how it's a powerful avenue for leveraging the magic of compounding interest. Have you considered how real estate can play a role in wealth building? Well, real estate can be a game changer. Imagine buying a property. Over time, the property's value tends to appreciate, and meanwhile, you can earn rental income. The compounding effect comes in when you reinvest those earnings into acquiring more properties or improving existing ones. Let's consider the example of a famous real estate investor, Robert Kiyosaki. He became a millionaire by purchasing properties with the help of leverage. Leverage in real estate is the use of borrowed capital, such as a mortgage, to increase the potential return on investment. By using other people's money to buy properties, Kiyosaki was able to capitalize on the power of compounding interest. So you can see that by using leverage and compounding interest, it's possible to accelerate wealth accumulation in real estate. But how can you get started? One way to begin is by educating yourself on real estate investing. Read books by successful real estate investors or study the strategies used by well-known millionaires. Additionally, find a mentor or join networking groups where you can learn from experienced investors. Once you feel confident, consider speaking with a financial advisor or mortgage broker to help you explore financing options and find the best property to begin your journey. In the comments below, share your opinion. Do you think investing in residential properties or commercial real estate is a better way to leverage compounding interest through real estate? Now let's talk about the importance of retirement accounts, such as 401k or IRAs. Retirement accounts are like turbocharged compounding machines. The money in these accounts is typically invested in a mix of stocks, bonds, and mutual funds. For example, when you contribute to a 401k or an IRA, your investments can grow tax-free or tax-deferred until you withdraw them in retirement. The magic of compounding happens as your contributions grow over time, generating earnings, and those earnings themselves start earning returns. This tax-advantaged status supercharges your compounding, allowing your snowball to accumulate even faster. Let me give you an example to demonstrate this. Imagine you invest $5,000 in a retirement account that earns a modest 7% interest annually. After the first year, you would have earned $350 in interest, bringing your total to $5,350. In the second year, the 7% interest would be calculated based on this new total, which means you would earn $374. Can you see how it starts accumulating? One way to leverage retirement accounts is by contributing regularly and, if possible, maxing out your contributions. Take advantage of any employer matching programs that might be available to you. This is essentially free money being added to your retirement savings. Another effective strategy is to invest in low-cost index funds or diversified portfolios within your retirement accounts. This allows you to diversify your investments while keeping fees low, increasing your overall returns. Now, it's your turn to put this knowledge into action. Start investing, no matter how small, and watch your money tree grow. And remember, the earlier you start, the more time your money has to grow. Thank you for watching. We hope you found this video helpful and enlightening. If you did, please give it a thumbs up and make sure to hit that subscribe button and the notification bell so you won't miss our future videos. We have a lot more financial wisdom to share with you. And let me know in the comments what money concept you want me to tackle next. The journey to wealth is a team effort. Let's get rich together. Remember, the key to wealth is in your hands. Until next time, take care and happy investing.